Welcome, everyone. Today, we're exploring a tale of two markets, a deep dive into the transition from the breakout growth stars of 2025 to the dominant titans of 2026. We'll be analyzing the top-performing stocks of this period and examining the broader thematic evolution of the U.S. market. Let's take a look at how these market leaders are shifting and what it means for the investment landscape in the year ahead.
Now, let's look at the market's narrative arc as it evolves from initial hype to sustainable hyperscale. We begin with 2025, defined as the year of thematic breakouts. This phase was characterized by high beta first movers delivering explosive returns across emerging sectors like AI infrastructure, clean energy, and the space economy. These were the pioneers capitalizing on early hype cycles. To understand where we are going, we must cross the bridge. This is where we identify durable trends by looking at the core drivers behind those 2025 winners, specifically the foundational and insatiable demand for data, compute, and power. This leads us into 2026, the year of Titan consolidation. In this phase, we expect to see established market leaders move in to capture and scale these trends, effectively translating disruptive innovation into durable, large-scale revenue streams. Essentially, we are moving from the volatility of discovery to the stability of institutional scale.
Looking back at 2025, it's clear we witnessed a defining breakout year for the market. While the S&P 500 delivered a solid performance in the 15 to 20% range, the top 5 breakout stars saw a dramatic outperformance of approximately 320%. This divergence was fueled by 3 primary macroeconomic tailwinds: the massive acceleration of AI adoption, the resulting surge in energy demands for data centers, and a strategic rotation of investor capital back into tech. Ultimately, the year was defined by the exceptional growth of companies positioned at the forefront of these emerging sectors.
Moving on to our top performer, Planet Labs, ticker PL. This company has seen an incredible year-to-date return of over 400%, positioning itself as a vital player in the AI infrastructure space. The core thesis here is that Planet Labs provides the fuel for the AI boom. By operating a massive fleet of satellites that provide daily, high-resolution imagery of the entire Earth, they offer the massive amounts of real-world data required to train advanced AI models. This has led to a surge in high-value contracts with government agencies and technology firms looking for AI-powered geospatial analytics. Looking at the key data points, Planet Labs operates in the aerospace and defense sector, with its market cap reaching the $2 to $3 billion range by the end of 2025. They've maintained a consistent revenue growth of around 30% year over year. However, we must weigh this growth against significant risks. The company remains unprofitable due to heavy R&D investment and faces increasing competition within the satellite technology sector. While the performance is historic, the path to profitability remains the primary challenge to watch.
Our number 2 performer is Iris Energy, ticker IREN, which has delivered a staggering 327% year-to-date return in 2025. The core thesis here is a masterfully executed pivot. Originally a Bitcoin miner, IREN has successfully repurposed its renewable energy data centers for high-performance AI computing. The primary catalyst for this growth was a landmark $600 million deal for 12,000 NVIDIA GPUs, which solidified their position as a critical AI infrastructure provider. Furthermore, their reliance on sustainable, hydro-powered energy provides a unique edge for ESG-conscious investors. Looking at the data, their market cap has expanded into the $5 to $7 billion range. They are currently trading at roughly 67 times forward earnings, reflecting the market's aggressive growth expectations. However, investors should remain mindful of the risks, specifically the intense competition from pure-play AI firms and IREN's sensitivity to volatile energy costs.
Our number 3 performer is Opendoor, which saw a phenomenal 305% year-to-date return in 2025. Opendoor has successfully monetized the housing market rebound by applying advanced AI to their core iBuying platform. The core thesis here is efficiency at scale. As the housing market recovered and interest rates lowered, Opendoor leveraged proprietary algorithms to buy, renovate, and sell homes more effectively than ever before. Specifically, AI enhancements to their pricing models improved their margins and significantly reduced losses, proving the strength of their tech moat. Looking at the key data points, we've seen revenue growth accelerate to roughly 40% year over year, with their market cap reaching the $4 to $6 billion range. However, investors should remain mindful of the risks. This model is highly sensitive to broader economic cycles and carries the risk of inventory overhang if the real estate market takes another downturn.
Moving to our number 4 performer, Oklo, which has seen a staggering 283% year-to-date return in 2025. Oklo is at the forefront of the next-gen nuclear movement, developing small modular reactors, or SMRs, designed to provide clean and reliable energy. The core thesis driving this growth is the AI revolution. AI data centers currently consume about 2 to 3% of all U.S. power, and Oklo is positioning itself as the primary solution to meet that massive demand with on-site power. Growth has been further catalyzed by favorable international nuclear agreements and partnerships with tech giants to pilot these solutions. From a data perspective, Oklo's market cap has reached the $10 to $15 billion range. It's important to note that they are currently in a pre-commercial revenue stage, though they are sitting on an exponentially growing backlog. Finally, keep in mind that this is still a highly speculative investment. The company faces significant regulatory and commercialization hurdles before these reactors are fully deployed.
Moving to our number 5 performer, AST SpaceMobile. ASTS has seen an incredible run this year, posting a year-to-date return of nearly 270%. Their mission is bold. They are building the first space-based cellular broadband network designed to connect directly to standard mobile devices, effectively eliminating global dead zones. The core thesis behind this growth is driven by successful test launches and massive partnerships with industry leaders like Verizon and AT&T. We also view this technology as a critical backbone for remote AI applications as we transition into a 5G and 6G world. Looking at the data points, the company's market cap has climbed to the $8 to $10 billion range. We're also seeing projected revenue growth of roughly 100% year over year as they ramp up from their testing phases. However, investors should remain mindful of the risks. This is a high capex business model that requires significant upfront investment, and the timeline is always subject to the inherent risks of satellite launch delays.
Now, let's look at the thematic handoff, where we see a shift from initial breakout hype toward foundational hyperscale. First, we've moved through the AI infrastructure demand shock. In 2025, the market rewarded foundational providers of data, compute, and power, specifically companies like Palantir, Iron, and Oklo. Looking into 2026, we expect growth to shift toward the titans who can design, manufacture, and integrate this infrastructure on a global scale. Second, in the new space economy, 2025 proved the value of specialized orbital infrastructure for data and connectivity. The implication for 2026 is a focus on monetization, as this space-based infrastructure is increasingly leveraged by terrestrial hardware and autonomous systems. Finally, we're seeing the AI-driven transformation of physical industries. We've already seen how niche applications can disrupt sectors like real estate. Moving forward, the focus will shift to industry leaders who are deploying AI across massive sectors, including automotive, healthcare, and enterprise software. In short, we are moving from the era of individual building blocks to a phase of massive integrated execution.
As we look toward 2026, we see a clear path for market titans to further cement their dominance. Analyst consensus points to sustained momentum across 4 critical pillars: AI, semiconductors, healthcare, and big data. The focus is shifting away from broad speculation and toward companies with durable moats, proven execution, and the scale necessary to capture the lion's share of market growth. These are high-conviction picks from leading Wall Street firms, each selected for their potential to deliver revenue growth exceeding 20%. Underpinning this entire outlook is one key assumption: that the current trajectory of AI spending remains sustained, projected to surpass $1 trillion in chips alone by 2026.
Now let's look at our high-conviction list for 2026. These 5 companies represent sectors we believe are poised for significant long-term expansion. NVIDIA leads the group with an impressive 63.1% projected revenue growth, reflecting its continued dominance in the AI and semiconductor space. We also see robust projections for Broadcom and Palantir, both expected to hit 47% growth as demand for AI infrastructure and software continues to scale. In healthcare, Eli Lilly remains a standout pick, with a high analyst target of over $1,200, while Tesla remains a key player in the transition to sustainable energy, with a projected growth rate of 25 to 30%. These selections are synthesized from several major financial sources, including Morgan Stanley and Bank of America, to identify where we see the most reliable upside over the next 2 years.
Now, let's turn our attention to our top outlook, NVIDIA. Positioned as the undisputed leader in the AI gold rush, NVIDIA has effectively become the central nervous system of the AI revolution, commanding a dominant market share of over 90% in GPUs for training and inference. The growth trajectory here is staggering, with a projected revenue increase of over 63% by 2026. This momentum is fueled by the ramp-up of their next-generation Blackwell and Rubin platforms, backed by a massive AI backlog exceeding $500 billion. What truly sets NVIDIA apart, however, is its technology moat. It isn't just about the hardware. Their proprietary CUDA software platform creates a powerful ecosystem that locks in developers and customers alike. Looking at the financials, we're seeing a market cap of approximately $4.6 trillion, with an estimated EPS of $7.46 for fiscal year 2027. Despite the rapid ascent, analysts at Bank of America view this as the midpoint of a decade-long cycle rather than the peak of a bubble, reinforcing Jeffrey's view that NVIDIA's ecosystem remains the gold standard in the industry.
Next, let's look at Broadcom, positioned here as the architect of custom AI silicon. While NVIDIA leads in GPUs, Broadcom has carved out a massive competitive advantage by supplying custom AI accelerators, or ASICs, and the essential networking components that power modern data centers. The financial momentum is undeniable. We're looking at a 47% projected revenue growth for 2026, supported by a staggering $73 billion AI backlog. Broadcom's unique strength lies in co-designing these chips directly with hyperscale customers. This creates a deeply integrated, high-margin business model that is difficult for competitors to displace. With a market cap of roughly $1.5 trillion and a valuation that analysts find reasonable given its growth profile, Morgan Stanley has highlighted Broadcom as a top-tier semiconductor pick for 2026.
Moving to our third outlook, Eli Lilly has solidified its position as a pharmaceutical titan, currently boasting a market cap of approximately $1 trillion. The company is at the forefront of the GLP-1 megatrend, with its market-leading drugs, Mounjaro and Zepbound, driving a massive 45% recent revenue growth, far outpacing the sector average. Our core thesis focuses on Lilly's ability to capitalize on powerful secular tailwinds, specifically an aging global population and rising obesity rates. Beyond their current blockbusters, their pipeline remains incredibly strong, featuring a potential oral obesity pill called orforglipron, which signals durable, long-term growth. Looking ahead, we are projecting 18.2% revenue growth for 2026. This optimism is shared by major analysts, with Bank of America naming Eli Lilly a top earnings grower for that year. In short, Lilly is well-positioned to turn these metabolic health breakthroughs into sustained shareholder value.
Next, let's look at Palantir, which is quickly becoming the definitive enterprise AI platform. As the graphic illustrates, their AI technology is designed to take the noise of complex, large-scale data and convert it into clear, actionable intelligence. We are looking at an impressive 47% projected revenue growth by 2026, fueled largely by a staggering 121% surge in U.S. commercial revenue. Palantir's core thesis is to become the foundational operating system for the modern AI-driven enterprise. While the current valuation is high at approximately 50 times sales, it reflects the company's unique strategic position and its success in both the government and commercial sectors. This momentum is why analysts like Dan Ives believe Palantir is on a trajectory to reach a $1 trillion valuation within the next 2 to 3 years. Moving on to our fifth outlook, let's look at Tesla. While the company remains a leader in EVs, the core thesis here is its transition into a dominant AI powerhouse. We are projecting revenue growth of 25 to 30% for 2026, driven largely by the unlocking of the multi-trillion-dollar autonomy market. Major catalysts for this growth include the 2026 launch of the Robotaxi service in over 30 cities and the production ramp of the Cybercab. This shift is significant because it moves Tesla toward high-margin software revenue. Their full self-driving software has the potential to hit 90% margins. Currently, with a market cap of approximately $1.2 trillion, analyst targets imply a potential for over 100% upside. While competition in the EV sector is intensifying, Tesla's deep moat in real-world data and AI infrastructure provides a unique advantage that is difficult for competitors to replicate. To wrap up our synthesis, let's look at how the market evolves from disruptive energy to scaled dominance over the next 2 years. In 2025, we are witnessing the rise of the breakout stars. These are our thematic first movers, high beta companies that are often pre-profit but are successfully proving out new markets like AI data needs, small modular reactors, and space connectivity. Their core value lies in identifying the foundational needs of the next technological wave and riding those initial hype cycles. Moving into 2026, the focus shifts to the dominant titans. These are the scaled market leaders who possess durable moats, massive cash flow, and proven global execution. While the stars pioneer the technology, the titans are the ones who manufacture, integrate, and ultimately monetize those innovations for a mass market. They are the ones poised to capture the lion's share of the long-term value. The key takeaway is that the disruptive energy of one year fuels the scaled dominance of the next. However, we must remain mindful of macro risks, such as interest rates and economic slowdowns, which could shift these growth timelines. Essentially, today's pioneers are building the foundations for tomorrow's giants.